Welcome to Option Strategies. Lately, the market has been very volatile. If you own stocks, it can be hard stopping to see the stock that you own has a big drop. In this video, we'll explore how we can use the option to protect the stocks you own without paying anything. First, we'll look at how to set up the strategy. The first step is make sure you own or buy 100 shares of the stock. Then, sell an out of the money call option. Finally, you want to buy an out of the money put option with the premium you collect from selling the call option. Make sure the put option premium is cheaper than the call option premium that you collect so that you do not have to pay for the protection. This is the option list for April with June 10, 2022 expiration date. The stock price is $146.50. In this example, I choose to sell the $150 strike price call and collecting $1.08 premium. Then I will buy the 142 strike price put by paying 98 cent premium. I'm collecting 10 cents from selling the call option and buying the put option. This is a profit or loss profile for the option trade. The break-even price is $146.40. The stock is protected if the stock price drops below $142.10, which means the maximum loss is capped at $430 or $4.30 per share. Unfortunately, the profit also capped at $150 strike price. Which is the strike price of the call option that I sold. The maximum profit is $360 or $3.60 per share. The pro of this selling call to buy put option strategy, which also known as option caller strategy, is providing free protection to the stock that you own while allows room for your stock to make gain. The con is the stock gain is limited. Now we'll look at how you can manage the strategy. The first situation is when the stock price drops below the put option strike price at $100.42. When the stock price drops below the put option strike price 142, let's say 140, the put option that we bought will become in the money and start to compensate for all the loss that we suffer below the put strike price. In this case, the difference between the stock price 142 and the put strike price 140, which is $2 per share or total $200. The trade is suffering the maximum loss of $430 or $4.30 per share. At this point, we can close the trade and take the loss or sell the put option and redeploy the option with new strike price. The call option will expire worthless, which we do not need to do anything about it. Now, we'll look at the second situation, where the stock price drops but stay above the put option strike price. When the stock price drops but stay above the put option strike price 142, let's say 144, the put option that we bought will expire worthless. The loss of the trade is the price we pay for the stock minus the stock price at expiration plus the premium we collect from the trade, which is $146.50 minus 144 plus 10 cents. The loss per share is $2.60 or total $260 for the trade. The next situation that we will look at is where the stock price increase but stay below the call option strike price. When the stock price increase but stay below the call option strike price 150, let's say 148, the put option that we bought will expire worthless. The profit of the trade is the stock price at expiration minus the price we pay for the stock plus the premium we collect from the trade, which is 148 minus $146.50 plus 10 cents. The profit per share is $1.60 or total $160 for the trade. The last situation that we will look at is where the stock price increase above the call option strike price. When the stock price increase above the call option strike price 150, let's say 152, the put option that we bought will expire worthless. Unfortunately, the call option that we sold will be in the money and limit the profit that we can make from this trade. The profit of the trade is the call strike price at expiration minus the price we pay for the stock plus the premium we collect from the trade, which is 150 minus $146.50 plus 10 cents. The profit per share is $3.60 or total 360 for the trade, which is also the maximum profit that we can make.